There are four words that show up right before every major market crash: 1929, 1987, 2000, 2008. The same four words every single time. And right now, in 2026, those words are everywhere again. This time is different, and I'm going to show you exactly why that should terrify you. To understand what's happening right now, you need to go back to the year 2000. Not for the history lesson, for the pattern. The 1990s were the decade when America fell in love with the stock market. Not Wall Street, not institutional investors, regular people, teachers, factory workers, retirees. People who had never bought a single stock in their lives were suddenly opening brokerage accounts, calling their brokers on lunch breaks, watching tickers scroll across the bottom of the evening news. A new language entered everyday conversation: PE ratios, IPOs, Nasdaq. The market had become a cultural event, and the belief driving all of it was simple. Technology had changed the rules. The old metrics didn't apply anymore. This was a new economy, and the old economy's caution was for people who didn't understand what was happening. And for a while, they weren't wrong. The Nasdaq rose 86% in 1999 alone. 86% in a single year. People who had put money in 2 years earlier had tripled it. People who had been skeptical in 1997 were watching their neighbors get rich and quietly reconsidering. By the peak, the excitement had become something closer to certainty, not optimism, certainty. The feeling that you had finally figured out how money actually worked. Here is what that certainty looked like in practice. Over the course of the year 2000, as the market was already beginning to crack, individual investors poured $260 billion into U.S. equity funds. That number needs context. In 1998, retail investors had put in $150 billion. In 1999, $176 billion. By the peak in 2000, that number had jumped to $260 billion, nearly double in 2 years. The people most aggressively buying were not the professionals. They were the last ones in. And here is the part that nobody talks about at dinner parties. While retail investors were pouring money in at a record pace, the people running the companies were doing the opposite. Between September 1999 and July 2000, insiders at dot-com companies sold $43 billion worth of their own stock. Twice the rate they had sold in 1997 and 1998. In the single month before the Nasdaq peaked, insiders were selling 23 times more shares than they were buying, 23 to 1. The people who built the companies, who sat in the boardrooms, who knew exactly what the revenue looked like and what the burn rate was and how long the runway actually extended, they were getting out, quietly, at scale, while the commercials ran and the magazine covers celebrated and the brokerage accounts opened. The people who got hurt were the ones who came in last. What followed was not a correction, it was a collapse. The Nasdaq fell 78% from its peak to its trough. 78%. The Philadelphia Semiconductor Index, the benchmark for chip stocks, fell 82%. Nvidia, the same company now worth $5 trillion, lost 90% of its value. Individual investors who had tripled their money on paper watched it evaporate. Not partially, not temporarily in a way that bounced back in a year or two. The Nasdaq did not recover its March 2000 high until April 2015. 15 years. A full 15 years for the index to claw back to where it had been. And for individual names, the companies that had been held up as the future of everything, the companies that analysts had assigned price targets of $500 and $1,000 and beyond, many of them never came back at all. Cisco, once the most valuable company in the world, still has not fully recovered its March 2000 peak more than 2 decades later. The revenue grew, the business survived, the stock price did not. $5 trillion in wealth was destroyed, not transferred, destroyed, gone from the net worth of ordinary people who had believed at the moment of peak certainty that they had finally understood how the game worked. That is what the last time looked like. Now here is the thing that is not making headlines. The thing that is sitting in plain sight inside every index fund and every retirement account and every passive investment portfolio in the country, unremarked upon, unexamined, treated as background noise while the conversation focuses on earnings beats and product launches and the next chip announcement. There is a structural signal that flashed in 2000 right before everything collapsed. And it is flashing again right now, louder than it was then. The signal is semiconductor concentration. In the year 2000, at the peak of the dot-com bubble, semiconductor stocks had climbed to roughly 7 to 8% of the entire S&P 500's market capitalization. That was the ceiling. That was the number at which the market's bet on chips had become, in retrospect, unsustainable. At the time, nobody was talking about it as a ceiling. They were talking about it as a floor. Technology was the future. Chips were the infrastructure of that future. The concentration made sense because the story made sense, and the story was, this time is different. You need to hold that number in your head, 7 to 8%. That was the dot-com peak for semiconductor concentration in the S&P 500. That was the historical extreme that preceded an 82% collapse in chip stocks and a 15-year recovery for the index. Now here is the current number, 18%. Semiconductors right now represent 18% of the entire S&P 500's market capitalization. Not 7 or 8, 18. More than double the concentration level that preceded the last crash. To understand how fast that happened and how abnormal that is, consider where this number was just a few years ago. In 2016, semiconductor stocks were roughly 2% of the S&P 500. 2%. Within a decade, that number went from 2 to 18%. The entire move, the entire transformation of chips from a cyclical industrial sector into the dominant force in global equity markets happened in less than 10 years, and the majority of it happened after 2022, after the arrival of large language models and the explosion of AI infrastructure spending. In 2020, semiconductors were around 4% of the market. Then AI happened, and in 5 years, 4% became 18%. That is not a trend. That is a vertical line on a chart. And the last time we saw a vertical line like that in a single sector's concentration within the S&P 500, it ended with $5 trillion in destroyed wealth and a 15-year recovery. The argument at the time was that semiconductors deserved to be a dominant part of the market because they were the infrastructure of the new economy. The internet ran on chips. Everything ran on chips. The concentration reflected a genuine structural shift in how the economy worked. That argument was not wrong. Chips were genuinely important. The internet was genuinely transformational. The problem was not the technology. The problem was the price at which the market had decided to value that technology, and the degree to which a single sector's performance had become the engine of the entire market's returns. That argument is being made again today, word for word, with slightly different nouns. Here is where the honest version of this conversation gets complicated, because the people making the bull case are not stupid, and their argument is not nothing. The companies at the center of today's AI concentration are not the companies at the center of the dot-com bubble. Pets.com was losing money on every transaction and burning through its IPO proceeds on Super Bowl commercials. NVIDIA generated $60 billion in data center revenue in a single quarter. Microsoft, Alphabet, Meta, these are not companies with no earnings and no business model. They are among the most profitable enterprises in the history of capitalism. The dot-com peak saw the Nasdaq 100 trading at a price-to-earnings ratio of around 200, with the majority of the companies in the index generating no earnings at all. Today, the Nasdaq 100 trades at roughly 30 times earnings. Elevated, but not 200. That is a real difference. It matters. Anyone telling you that today is identical to 2000 in every respect is not giving you the full picture. But here is what the bull case does not fully account for. Big tech is planning to spend somewhere between $650 and $700 billion on AI infrastructure in 2026 alone. That is not a misprint. $650 to $700 billion in a single year, building data centers, buying GPUs, laying the physical foundation for an AI economy that is projected to be transformational. The capex is enormous. The ambition is real. The spending is happening. And MIT research published in August 2025 found that 95% of organizations report getting zero measurable return on their generative AI investments so far. 95%. One analysis calculated that AI facilities coming online in 2025 face roughly $40 billion in annual depreciation costs, primarily from expensive GPUs that become obsolete quickly, while generating only $15 to $20 billion in revenue at current usage rates. The hardware is depreciating faster than the revenue is materializing. The spending is real. The infrastructure is being built. The technology works. None of that is in dispute. What is in dispute is whether the market has priced all of that correctly, whether the earnings that are supposed to justify the concentration have arrived yet, and whether the gap between the capital being deployed and the returns being generated is a temporary lag or a structural problem. In 1999, the infrastructure argument was also real. The fiber optic cables that were laid during the dot-com boom sat dark for years after the crash, and then they became the foundation of the internet economy that followed. The infrastructure was right. The timeline was wrong. The valuations were catastrophically wrong, and the people who paid those valuations waited 15 years or never got their money back. Here is the part of this conversation that most people never reach, because most people hear AI bubble and think, I don't own NVIDIA. This doesn't apply to me. I'm in a diversified index fund. I'm fine. You are not fine. Or rather, you may be fine, but you are not diversified in the way you think you are. If you own an S&P 500 index fund, and hundreds of millions of Americans do through their 401ks, their IRAs, their employer retirement plans, the top 10 stocks in that index right now represent nearly 40% of your total investment. 40% of your money is in 10 companies, and those 10 companies are overwhelmingly concentrated in the same sector, in the same AI infrastructure theme, exposed to the same risks, moving in the same direction when sentiment shifts. At the height of the dot-com bubble, the top 10 stocks in the S&P 500 represented just under 30% of the index. Today, that number is nearly 40%, higher than the dot-com peak, higher than any point in the last half-century. The index has never been more concentrated than it is right now. You did not choose those positions. You did not decide to put 40% of your retirement savings into a handful of technology companies. The formula did. The passive investment structure did. The market cap weighting did. You bought the index because you wanted diversification, because you wanted to spread your risk across 500 companies, because that was the responsible, long-term, sensible thing to do. And what you actually got was a portfolio where nearly half your money moves with 10 stocks. Now, consider what that means in practice. The top 10 S&P 500 stocks currently account for nearly half of the total volatility in the entire index. Not half of the weight, half of the risk. When those stocks move, when NVIDIA has a bad earnings report, when a Chinese AI startup releases a model that costs $5 million to train and performs comparably to one that cost $5 billion, when the market decides, as it eventually always does, that the future is arriving on a different timeline than the price implied, the ripple goes through everything, through your 401k, through your retirement date fund, through the diversified portfolio you built because you did the responsible thing. You are already in this trade, whether you know it or not, whether you chose it or not. So let's come back to those 4 words. This time is different. Here is the honest version of that sentence. The companies at the center of this run are genuinely profitable in a way that the companies of 2000 were not. The technology is real. The demand for AI infrastructure is real. NVIDIA's revenue is real. The transformation happening in how the global economy uses computation is real. If you are arguing that AI is not going to be important, you are probably wrong. None of that is the argument. The argument is about price, about concentration, about what happens when a single sector becomes 18% of the entire market and the top 10 stocks represent a larger share of your savings than at any point in modern history. About the gap between $650 billion in annual capex and the 95% of organizations not yet seeing returns. About the difference between a technology being real and a market having priced that technology correctly. In 2000, the internet was real. The internet was going to change everything. The internet did change everything. And the people who bought at the peak in March 2000 waited 15 years to be made whole. If they held on, if they didn't sell at the bottom, if they picked the right companies and not the ones that never came back. The technology being real did not protect them. The four words, "this time is different," are not always wrong. Sometimes things genuinely are different. Sometimes a new technology does change the rules in ways that make old valuations look cheap in retrospect. That has happened before, and it will happen again. But historically, in every single instance where those words were spoken at the peak of a market cycle with the same certainty they are being spoken right now, the people who said them paid for that certainty. Not because the technology failed, because the price was wrong. Watch the concentration. Watch the gap between spending and returns. Watch what happens when the market decides the timeline has shifted. And the next time someone tells you this time is different, remember what those words have cost every single time before.